Welcome to Iron Financial. This is where we forge stronger portfolios by cutting right through all the market weakness and noise. Today, we are tearing down the Goodyear Tire and Rubber Company's latest earnings report. And believe me, this isn't just a story about tires and rubber. No, this is about a corporate giant taking a literal wrecking ball to its own structure, all in the hope of building something much, much stronger from the rubble. So we're going to do what we do best. We're going to examine the blueprint, we're going to inspect the demolition site, and then we are going to stress test this new foundation to see if it's a skyscraper in the making or just a house of cards waiting for the slightest breeze to knock it all down.
All right, just look at these numbers on the screen. It is a picture of total, absolute contradiction. I mean, you've got a stellar fourth quarter, the best they've had in years, sitting right next to a catastrophic annual loss. Let's break it down. On one side, you're looking at a fourth quarter net income of $105 million. Okay, fine. But the real story here is the segment operating income. It hit $416 million, which gives them an 8.5% margin. Now, management is, rightfully bragging about that. It's the highest operating margin they've seen in over 7 years. It looks like a well-oiled machine just hitting its stride. So which is it? I mean, is the company firing on all cylinders, or is the engine about to completely seize up? This is exactly the kind of headline noise that traps investors. It's a classic case where you look at one set of numbers and you see a champion, but you look at the other and you see a company that looks like it's on life support. Exactly, because on the other side of this ledger, you have a full-year net loss of $1.7 billion. That is not a rounding error, my friends. That is a crater. And it's almost entirely driven by these enormous non-cash charges. We're talking about a $1.5 billion tax asset write-down, plus another $674 million in goodwill impairment. It is a complete Jekyll and Hyde report, and our job today is to figure out which personality is the real one.
And that right there is the billion-dollar question, isn't it? You simply cannot answer that by reading the headlines. You have to understand the story that's happening behind the numbers. To find the real answer, we have to look past the pretty press release and, get our hands dirty sifting through the demolition work the company has been doing. This is not a simple tune-up we're talking about. This is a full-scale, ground-up renovation, and believe me, it is messy. Okay, let's dive into this thing.
Every single major rebuild starts with demolition. It's messy, it's expensive, and it's exactly what Goodyear has been up to all across the globe. They are taking a sledgehammer to their old legacy operations. They're closing plants, they're cutting deep into their workforce. This is that painful but absolutely necessary first step in any serious turnaround attempt. You have to clear the lot before you can even think about pouring a new foundation. Let's start with the hard numbers, the real-world impact. In Danville, Virginia, they're slashing nearly 1,000 positions. Why? To completely stop making commercial tires at that facility. The total price tag for just this one action is expected to be somewhere between $150 and $160 million. And let's not forget the human cost here. 1,000 jobs. That is a massive blow to a local economy. And you've got to understand this isn't some isolated incident. This is a pattern. It's happening across the board as they try to get rid of what they call high-cost manufacturing capacity. It's a brutal move, for sure, but it tells you just how serious they are about shedding parts of the business where they just don't see a future. And the costs just keep stacking up. This isn't just an American story either. Over in Germany, they've already set aside more than $200 million just for shutting down 2 entire plants, Fulda and Fürstenwalde. Look, this isn't trimming the fat around the edges. This is amputating entire limbs of the company. These are huge industrial sites with long, storied histories that are now, for all intents and purposes, being wiped off the map. When you see numbers this big associated with closures, it signals a fundamental strategic retreat from certain markets and certain product lines. It's a massive move.
Now, what's really, really interesting about this slide is the sheer scale of it all. As you can see right here in the table, we're not just talking about 1 or 2 plants. Let's just walk through it together. We already mentioned Danville, where, by the way, they've only accrued $16 million of a total cost that could hit $160 million, so there's more pain to come there. Then you have the German closures with $214 million already on the books. On top of that, tack on another $52 million for a broader workforce reorganization across Europe, the Middle East, and Africa. And then the big one at the bottom, $354 million for the full year in asset write-offs and accelerated depreciation across multiple locations. This is the financial rubble from tearing down the old, inefficient parts of the business. Every single line item here represents a tough, painful decision to cut a non-performing asset to free up capital and sharpen their focus. You call it rubble, I see a company in full retreat. They are spending an absolute fortune just to get smaller. How is that a foundation for growth? You're telling me they're burning through over $1/3 billion in a single year just on the cost of shutting things down. That's cash that isn't going into R&D. It's not going into marketing. It's certainly not going into building a better product for their customers. It is, plain and simple, the cost of past mistakes. And while all this is happening, let's not forget the core business is still facing some tremendous pressure.
Because demolition clears the ground for a stronger structure. You can't build on a rotten foundation. You just can't. All of that spending is really an investment in future efficiency. So now let's turn the page and look at the blueprint for the rebuild. It's called the Goodyear Forward plan. This is the part where all the chaos of the demolition starts to actually look like a coherent, intelligent strategy. Right, this isn't random destruction, it's a very deliberate strategy. Goodyear Forward is all about focusing on what works and ruthlessly cutting what doesn't. They announced it in late 2023, and it's basically their roadmap out of the wilderness. It's all about simplifying the business, getting leaner, and zoning in on the most profitable segments of the market. Honestly, this plan is the entire bull case for the stock. Its success or its failure is going to determine the fate of this company for the next decade. No pressure. And the plan itself is built on 3 really solid pillars. It's a classic turnaround playbook, and for good reason. First step, portfolio optimization. Basically, sell what isn't essential. They identified their chemical business, the off-the-road tire business, and the Dunlop brand as non-core. So get rid of them. Take the cash. Simple. Second, margin expansion. This one is huge. They're aiming to cut $1.3 billion in costs by the end of 2025, and at the same time, shift their focus to high-margin premium tires. And third, deleveraging. Take all that cash you made from the asset sales and use it to strengthen the balance sheet by aggressively, relentlessly paying down debt. It's simple, it's logical, and it's incredibly powerful if, and it's a big if, they can actually execute it.
And guess what? They're executing. This isn't just some fantasy on a PowerPoint presentation. They are delivering real results. They aim to sell $2 billion in assets. They actually brought in $2.3 billion. That's a solid beat of $300 million. And that tells you 2 very important things. 1, that there's real value in the assets they're selling, and 2, that this management team is capable of closing the deals and getting it done. This is tangible proof that the plan is way more than just talk.
Okay. Paying down debt is good. I will absolutely give them that. $1 billion less in debt is a tangible, real improvement. It lowers your interest expense, it reduces your financial risk, no question about it. Their long-term debt went from $6.4 billion down to $5.3 billion in just a single year. That's a serious step in the right direction, and it definitely strengthens the foundation. But where are the profits from the actual business? Selling off the family silver is a one-time trick. You can't sell your assets forever. What about the core operation of just making and selling tires?
Right here, this is the payoff. This is the answer to your question. The core business is showing its new strength. That 8.5% operating margin in the fourth quarter, that is a huge number for this industry, and it's their best in nearly a decade. This proves that the cost-cutting and the portfolio changes are working. The demolition and the streamlining are resulting in a more efficient, more profitable operation. They generated $192 million in benefits from the Goodyear Forward plan in Q4 alone. The point is, the new structure is more profitable. This isn't just financial engineering. This is real operational excellence finally shining through.
A profitable quarter is one thing, but a fortress has to be able to withstand a storm. You can build the most efficient factory in the entire world, but it's completely worthless if nobody is buying your product. The wider market out there is looking shaky, and I am seeing some very serious cracks starting to appear in this shiny new foundation. The internal rebuild, sure, it looks impressive on paper, but the external environment is just brutal right now.
Yeah, let's get real for a second. For the full year, they are selling fewer tires, period. Unit volume was down 5.4% year over year. That is a significant drop. Then you've got costs from inflation and tariffs hammering them for over $500 million, $543 million to be exact. And the adjusted net income, the number they want you to look at after stripping out all the one-time demolition costs, that number was cut in half year over year. It dropped from $278 million in 2024 to just $136 million in 2025. The new building might be leaner, but the neighborhood is getting rough, and customer demand is clearly weakening. And this is exactly why the stock dropped after the announcement. It fell 6% in post-market trading. Despite the strong operational performance, despite that record margin we talked about, they missed the street's earnings per share estimate. The analysts were looking for 49 cents a share. Goodyear delivered 39 cents. That 10-cent miss, even with all the positive operational news, shows you that Wall Street is still pricing in all of those headwinds.
The market is basically saying, hey, great job on the cost cutting, but it's not enough to overcome the storm clouds that are gathering on the horizon.
And this slide right here brilliantly illustrates the risk. And look, this isn't my opinion. This is what the quantitative models are absolutely screaming. Independent analysis from GRU Focus puts the company squarely in the distress zone. Let's break this down. The Altman Z-score, which is a classic predictor of bankruptcy, is at 1.4. Now, for anyone watching, anything below 1.8 is considered a high risk of bankruptcy within the next 2 years. That is a major, major red flag. Then you've got the Piotrowski F-score, which measures the strength of a firm's financial position. It's a dismal 3 out of a possible 9. And that debt-to-equity ratio, even after paying down $1 billion in debt, is still over 3. This isn't just a tough quarter. These are signs of fundamental financial weakness that you simply cannot ignore. All right, we've seen the demolition site. We've inspected the blueprints for the rebuild. We've stress-tested the new foundation. We've looked at the billion-dollar losses and the record-high margins. It's time. It's time to put it all together and render the final verdict. Is this a solid structure being built for the future, or is this a classic value trap designed to lure in unsuspecting investors?
The bull case is clear, and you know what? It's pretty compelling. You have to listen to what the CEO, Mark Stewart, is saying here. Management is executing a difficult but absolutely necessary plan. The demolition phase, with all its ugly headline losses, that massive $1.7 billion net loss, is mostly accounting noise and non-cash charges. Things like the $1.5 billion deferred tax asset allowance, that doesn't actually drain cash from the company's bank account. The rebuild, on the other hand, is real and tangible. Debt is down significantly, margins are at a 7-year high, and the core business is stronger and more profitable than it has been in years. The bull sees all the rubble being cleared away to reveal a stronger than ever foundation underneath. But the bear case is just as compelling, maybe more so. You can't build a strong house in the middle of a hurricane. Demand is falling, with tire volumes down over 5%. Costs are rising, with inflation and tariffs creating a $500 million headwind, and crucial third-party metrics are saying the company is still financially distressed, with a real quantifiable bankruptcy risk. That massive gap loss, even if it's non-cash, reflects the serious deterioration in the value of the company's assets. And the market's own verdict was crystal clear. An EPS miss spooked investors and sent the stock tumbling. That record operating margin means nothing if you can't sell your product and the very ground underneath you is unstable. So it all comes down to this. Do you believe the internal rebuild is strong enough to withstand the external storm? The bulls, they're betting on management. They're betting on the execution of the Goodyear Forward plan. They see the solid pillars, lower debt, higher margins, a leaner operation. And they are more than willing to look past the ugly headline numbers to see the structure underneath. And the bears are staring right at the cracks in the armor. They see weakening demand, they see persistent external pressures, and they see quantitative models that are flashing bright red warning lights. It's a classic value trap versus a deep value play. So is this a solid foundation actually being built, or are they just rearranging the rubble on a sinking ship? For investors at Iron Financial, this is a structure that requires extreme diligence. The answer depends entirely on whether those operational improvements can outrun the macroeconomic decay.
Only time is going to tell if this rebuild can truly hold its own weight. Will the improved margins be enough to weather falling volumes and rising costs, or will these external pressures cause these brand new foundations to crumble? As always, this is not financial advice. But here's the one question you need to ask yourself. Are you betting on the architect, or are you betting on the storm? Forge your own path.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.